In this video, we're going to go over a few things. Number 1, deciphering financial jargon. Number 2, the importance of buying the dip. Number 3, understanding key metrics. Number 4, analyzing what's called the PEG ratio. That's not what you think. Considering leadership and conviction, and managing risks and diversification when investing. One of the most confusing things in finance is the use of jargon. You could call this jargon monoxide. It basically just exists to confuse you and to keep you from investing on your own, often requiring the help of a financial professional to be able to do it for you if you don't want to learn. Luckily, if you're here, it probably means you're willing to learn. The reality of finance is that a majority of it requires only elementary school level math. So that's arithmetic if you want to use some jargon monoxide. Pretty much no one except those who work in finance or have some sort of weird fascination with finance know what words like mutual fund, index fund, or expense ratio mean. The acronyms get even more confusing and vague, kind of like the movie Inception. EBITDA, EPS, PPE, ETF, and on and on and on. So many acronyms. Something I was hearing over and over when I first started investing was buy the dip, but I didn't really know what that meant. At the time, it meant nothing to me, but now I realize it's the most important buying opportunity that we can ever come across. Buying the dip refers to buying an asset, which could be a fiat currency like US dollars, could be cryptocurrency like Bitcoin, could be stocks like an Apple or Microsoft, a bond like a treasury bond, or an ETF like VTI, or some sort of index fund or mutual fund, when that particular pricing for whatever that asset is very low, or whatever that security is. In theory, this could even be buying a used car when used car prices are low. But how do we know when something is priced well? One of the best indicators and what people usually look at when buying the dip is the 52-week range. This is a metric that just tracks the highest and lowest prices of an asset in the last year. It's usually going to be looking at a security, but again, could be looking at anything. We could even look at the watch market if we wanted to. If something is at the low end of a 52-week range, it usually means that it's relatively cheap, but anyone who works in finance will tell you that metric is pretty much bullshit. Luckily, this isn't the only indicator that we have. Also really important when buying a stock is the earnings per share. So this is how much the company made divided by the number of shares that are outstanding, the number of shares that exist in the marketplace. And it's typically a marker of a company with good cash flow or financial health. To illustrate this, I'm going to use an example. Imagine you have a successful gourmet cookie shop. We'll just call it Crumb. Because it was very expensive to start, you have 2 business partners, and you all have equal stake in Crumb. You've decided that Crumb will start with 1,000 shares, and because you each own a third, you each have 333.33 shares. During the year, Crumb brings in $100,000 in revenue. This means your EPS on those earnings would be $100,000 divided by the 1,000 shares that 3 of you have. So that would be $100 as your EPS, meaning $100 per share. Something you might notice right away when you get into investing is that some companies have hundreds, thousands of shares. This can kind of erode the meaningfulness of EPS. Because there are so many shares and companies can only make so much money, most companies have an EPS of much less than $100 per share. So that would be generally pretty high. This means that if a company has an EPS of $100 per share, it doesn't necessarily mean that it's a better company than one with an EPS of something like $10 a share. The most important part is that it's positive and increasing over time. Confusing, I know. Another metric we can look at is called the PEG ratio, and it's not what you're thinking. It has nothing to do with cribbage. The PEG ratio is a company's price to earnings ratio divided by its earnings growth rate over a period of time, which is typically in the next 1 to 3 years. This makes a little more complicated of an equation, but we're still just using elementary school level math. This metric can be particularly helpful when it comes to adjusting companies that have a high growth rate, but also a high price to earnings ratio. A low PEG ratio of a fast growing company around or under 0.5, for example, represents a company that may be cheaper when its growth rate is taken into account versus a company with a PEG ratio of 0.8. That's growing at a very slow rate. One of the risks of using a PEG ratio is that it usually looks forward 1 to 3 years, which is a pretty short time horizon in the world of stocks, especially if you want to be investing for something like retirement. This also typically means that there's more risk involved if you're investing on a shorter time horizon. There are many other metrics you can look at when you're looking at a stock, but we'll leave it at those 3 for now. Beyond most metrics, it's extremely important to pay attention to the leadership team. If they have a sketchy history, I won't invest. New ventures aren't always going to be different. For better or for worse, history and what's happened in the past tends to be our best predictor of what's going to happen in the future. This includes conviction in the ideas that the company is driven by. If I don't believe that a company has a future, or if the leadership has a history of fraud, or if they're doing sketchy things like living on an island outside of the United States for a US-run company, then I divest or I don't invest in the first place. It's also important to manage our risks and properly diversify. Remember that buying individual stocks is risky business. Not too dissimilar to gambling, especially if you're trying to make money over the short term. When I say short term, I'm talking about investing over a period of 5 or fewer years. In the world of investing, that is a pretty short time horizon. I always prioritize low-cost broad market index funds that offer reduced risk through diversification and historically have had good performance. The advantage of investing in these index funds and ETFs is they can rebalance on their own as well. So a professional can do it for you at a much lower cost of paying a financial advisor. In this video, we covered deciphering financial jargon, the importance of buying the dip, a lot of key metrics, using different ratios like the PEG ratio to analyze a stock, considering leadership and conviction of a certain stock or company, as well as managing risks and diversification. Don't forget to subscribe to Benjamins with Ben and subscribe to the newsletter in the description below. As always, thanks for watching.